Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There are going to be multiple data points between now and the end of the year that will give the Fed more confidence to potentially do 2 rate cuts this year instead of the one that they've got penciled in their latest dot plot. There's going to be updates on inflation. If we continue to see inflation moving in the right direction, I think the Fed's going to feel a little bit more confident that they'll be able to cut rates more than once this year.
Investors aren't all that confident about anything outside of the AI phenomenon. And we haven't seen the big broadening out of earnings outside of the AI phenomenon. We have this, the people are making the chips, the picks and the shovels are doing well, but it's not, we're not seeing the end users of these chips really, seeing a big increase in earnings.
Tesla has a couple of very unique advantages in our view. One being that we do think that they could probably launch perhaps the cheapest and lowest cost robo-taxi platform out there, not only from a hardware cost perspective, but also from an operating cost and network cost perspective. And if we're right about that, that could actually lead to potential new opportunities of how to deploy autonomous vehicles.
We got 1 hour to go until the market close, so let's take a look at the major averages here. We are seeing them push higher, and in fact, we're seeing a number of Wall Street strategists also get more optimistic today. Evercore ISI coming out with the highest target on the street for the S&P 500. That's our friend Julian Emanuel, putting it at 6,000 potentially. Meantime, Goldman Sachs and Citi strategists are also raising their targets for the S&P 500 to 5,600 each. So we've got the Dow higher today by about 180 points. Not a lot of fundamental news pushing things higher, although we are going to see some Treasury and corporate bond issuance this week that's pushing around the bond market. We'll get to that in a moment. The S&P 500 pushing to a new record today with this 0.9% increase that we are seeing. And the Nasdaq as well, 6 days in a row that we have seen the Nasdaq Composite set new records. Now, I mentioned the bond market, so let's get a quick check there because we are seeing a little bit of pressure on prices, a little bit of an uptick in yields happening here today, up by 6 basis points, still quite low, though, at 4.28%. And then if we look at how all this is translating into the sector action here, with those yields higher, a little bit of pressure on utilities and real estate, which tend to be interest rate sensitive, consumer discretionary, tech, and industrials are helping lead the pack here. And then quick check on the Nasdaq 100 here today, because we see once again, despite repeated discussions about how narrow the leadership is, it's still narrow. Nvidia is trading at a record again, Apple pushing higher, Microsoft pushing higher. So we are still seeing that ultra large cap tech strength, Josh.
Thank you, Julie. The Nasdaq and the S&P 500 on track to close at new records as several big tech names helping drive the rally. For more on the latest moves, we now welcome in Michael Darda, Roth MKM Partners Chief Economist and Macro Strategist. Mike, it is always good to see you. So let's start here, Mike. So Goldman raises its 2024 target for the S&P 500 to 5,600. Citigroup does the same. Evercore, Mike, goes to 6,000. So maybe start there, Mike. How are you feeling about this market? Are you feeling as optimistic as some of your colleagues, Mike?
Well, thanks for having me on. Always my pleasure. No, I am definitely not feeling as optimistic as some of my competitors out there. But look, credit to where credit is due. If you've been bullish and you've just been following the trends and you've been following the momentum, that's been the right play this year, and it was the right play last year. So I think what's happening here is this market just taking off, and now the chase is on, and folks are just going with the trend and extrapolating that out into the future. And that's a double-edged sword, because if the trend doesn't change, then you'll be right. But if it does, then that's like walking straight off a cliff. So I am not optimistic. I mean, it's going to be difficult to time, but when valuations get this stretched and the leadership is this narrow, I think we are set up for pretty weak future returns. But the timing is a real challenge.
Hey, Mike, it's Julie here. So even if it's going to be difficult to time, maybe you could give us an idea of what the contenders are for being that catalyst, though, because things usually don't just change just because valuations get stretched, for example. Usually there's some kind of trigger. What are your candidates for that trigger?
Yeah, great question. I think we have two dominant themes right now. One is obviously the AI frenzy. And so there is a tremendous amount of optimism that AI is going to bring tremendous broad-based benefits. And so that's why the valuations are going up. We have the Infotech index within the S&P 500 at a 30 forward multiple. So that's even a little bit above where we were in late 21, early 22, when valuations got really high. And then we had a more than 30% downdraft in the sector in 2022. Now, the causes were a bit different. People were worried that we might be going into recession. We had rapid inflation, rapid rate hikes. So this time around, I think something has to interrupt the story in terms of AI delivering all these benefits, and that's going to take time to play out. Right now, the expectations are quite high, and the higher they go, I think the bigger the risk is that we ultimately end up a bit disappointed about what's in front of us. The other dominant theme, in addition to the AI frenzy and a lot of enthusiasm there, is the soft landing story, which has been playing out. Fears that the economy wouldn't make it through last year without a recession, and we made it through, and then some. And payroll growth has stayed quite strong, even though the Fed did all of these rate hikes, the most rapid tightening campaign in 4 decades, and the economy is held in there. And so the soft landing, we've essentially been in a soft landing since the Fed stopped raising rates last summer. And so that theme has not been interrupted yet. And there's a lot of enthusiasm over the fact that the Fed likely will cut rates. That will be the next move. And I think the assumption is that any rate cuts at any time for any reason will simply be bullish. And I would challenge those assumptions, all 3 of them. Typically, when the Fed is cutting rates, things are going wrong with the business cycle, and we don't have to look back that far to see markets peaking and starting to roll over just as the Fed is starting to ease. That actually happened going into the 07-09 recession, one of the longest and worst in history, one of the most significant bear markets. So I think the idea that any rate cuts for any reason at any time is simply bullish, I think we're on pretty flimsy ground with that assumption.
So Mike, given that that broader view you've got, if that's your backdrop for equity investors who are listening right now, what are the investment implications of that, Mike?
Well, I think the implications are we have to be very careful about just chasing the momentum here. There's an old Bob Farrell quote that parabolically rising markets do not correct by going sideways. And so it's very unlikely when you're in a frenzy like this with a lot of chasing that it just simply peters out and levels off. And so my advice would be not to get involved in a chase, not to be using leverage, and then really just the basics, diversify. Maybe look at some areas that have been laggards, all within the context of putting together a multi-year portfolio. I mean, most of your viewers are probably not day traders. I don't have any advice to anyone day trading. So if you're investing, it really should be a multi-year horizon. And within that context, I would look at some of the areas that are lagging behind. Value stocks, maybe down the capitalization structure. We have a rare moment in history where the Russell, the small cap stocks, are at a lower forward valuation than the S&P 500, which has been dominated by these big tech players. So, that's not a call for the next week or the next month, but I think over a multi-year horizon, what the individual investor should be doing is diversifying, not chasing momentum, and maybe looking at some of the laggards as a contrary play.
And Mike, when we try to figure out what this next period of time is going to look like as well, one of the charts that caught my eye in your latest note, you were talking about the inversion of the yield curve, right? And the fact that that is usually a recession signal. And you also have a chart of how stocks have done after past inversions. And stocks right now have done a lot better for a lot longer than we have seen in prior cycles here. So what do you think that reflects? And do you think that, that the recession is going to come even maybe before the end of the year or early next year?
Yeah, thanks for that question. So the yield curve, depending on which curve you look at, inverted, anywhere between the summer of 2022 and the fall. So, almost 2 years ago now. And obviously, the fall of 2022 was the bottom of the S&P 500 after a 25% correction. And so we've zoomed from there. It's been an enormous rise. And it's mostly the price level because earnings estimates are only up 7 to 10% or so from there. So we've had a huge valuation expansion for the S&P 500 because the economy didn't fall into recession and people are very excited about AI. So it's been the best performance for the S&P 500 post-inversion in history. Now, part of that is that we also fell 25% going into the period where the curve first inverted. And so, what does that mean for the future? I think it means that we have a lot of gains in the bag here and the expectations are exceptionally high. And maybe we shouldn't just assume that we're out of the woods and that the yield curve has failed as a recession signal. The longest business cycles have survived after an inversion has been 24, 25 months. And we're almost, but not quite there. In this environment, and if you just looked at the equity market or risky credit, you would think no trouble ahead, everything's great. But there are signs of slowing and even a potential downturn shaping up with the unemployment rate now 0.6 of a percentage point off of the lows of the cycle. That's only something that we've ever seen in history at the very end of a business cycle expansion or the early innings of a downturn. GDP, even payroll growth can get drastically revised. And it's not uncommon or unprecedented, rather, that equity markets run right up until a recession hits. I mean, in 1990, the S&P 500 peaked right as the business cycle peaked. In 2007, the S&P peaked just 2 months before the recession started. So it's not like, the equity market is going to give us an all clear signal for, quarters and years ahead. Sometimes it's just right on top of the business cycle, not really looking forward as much as people would think.
Mike, it's always good to get your insight. Thanks a lot. Appreciate your time.
Anytime. My pleasure. Thank you, too.
GameStop's annual shareholder meeting is taking place today following a technical issue last week that cut the meeting short. Yahoo Finance's Ines Ferre has been following along. She joins us now for more. We even, I believe, got a few words publicly from Ryan Cohen.
Yes, that's right, Julie. He spoke at the top of the meeting in some prepared remarks. And basically what Ryan Cohen said, he's the chairman and CEO of GameStop. He said, with respect to retail operations, we plan to continue reducing costs and focusing on profitability. He also cited a smaller network of stores. We've known that the company has been cutting costs. He also said that, and this is really sort of the money quote where he sort of nods at all of the meme trading that has been taking place over the last month or so. We are not here to make promises or hype things up. We're here to work. Now, the stock is down 10% now, but it was down as much as 15% during the meeting. The company didn't say much as to how they are going to use all the cash that they have accumulated over the last few share offerings. Remember that in this past month, they have offered millions of shares and they have raked in about more than $3 billion in proceeds from those sales. The general counsel during the meeting said that they were getting a lot of questions about the future of GameStop plans going forward, but he wouldn't be commenting beyond what Ryan Cohen commented, beyond those comments that he gave at the top of the meeting. This all started really when we know last month when we saw the meme rise rally after Keith Gill started appearing on social media, and the stock has been on a real whirlwind. As far as Keith Gill, aka Roaring Kitty, he did post more than an hour ago a picture of John McEnroe. He's one of a famous tennis player from the 80s, known to be sort of controversial, so to speak, on the court. So make of it what you will with that message.
I don't know what to make of that. He pulled a McEnroe. No, then he would be throwing a racket. McEnroe has mellowed a lot over the years. Fun fact. All right, thanks, Ines. Appreciate it.
Thank you.
Well, we're just getting started here on Market Domination. Coming up, more Fed commentary today signaling one rate cut this year. We're going to speak to a former Fed president later in the hour about the path ahead for the fight against inflation. Plus, tomorrow we'll have an exclusive interview with Federal Reserve Bank of Boston President Susan Collins. She'll be discussing rate cut trajectory in our 4 o'clock hour.
And this week, Yahoo Finance will be bringing you inside the 2024 Cannes Lions International Festival of Creativity. We'll be hearing from the movers and shakers in the world of marketing, advertising, sports, and media. Stay tuned. More Market Domination coming right up.
Let's check in on a few trending tickers from Yahoo Finance right now. Autodesk is on the list. It's higher by about 7% on reports that activist Starboard Value has about a $500 million stake in the company. Yahoo Finance is at the 2024 Cannes Lions International Festival of Creativity and had the chance to speak with Autodesk's chief marketing officer about the report.
One of the things that we are focused on is listening to our shareholders, right? So we want to hear what all our shareholders have to say, right? As a board, as a management organization, we're focused on making sure that we're listening. And you know, we take constructive input. So we're making sure that we're learning, we're listening is important. But you know, we are very confident in our strategic direction. We're confident in how we're operating as an organization. We just recently released our first quarter earnings for 2025. We had a 13% year-over-year increase in constant currency. So we're proud of the results, and we'll continue to improve and continue to work.
So saying, they're listening to shareholders. Jeff Smith at Starboard is not your typical, everyday shareholder, though, and he wants some changes at the company, wants governance improved according to the Wall Street Journal, and that margins need to get better as well.
Yeah, according to Bloomberg, he has thoughts about a range of issues, Julie. Yeah. Jeff does. Expenses, capital return, acquisitions, wants these changes to the board. Apparently filed this lawsuit, get a delay of the company's annual meeting. It was set for, I guess, next month, mid-July, but trying to force them basically reopen that nomination window.
Right, because the company had been looking into its accounting practices and had found some, stuff that maybe wasn't up to snuff, but then came out and ended up filing
SEC, DOJ. They said,
exactly. So they ended up just coming out with their earnings as expected. They didn't have any material changes to that. But nonetheless, Starboard says they want to get that window reopened. As you said, the meeting is set for July 16th, and so they want more time to be able to nominate.
We'll see how it plays out.
We will.
Well, here's another one. Adobe being sued by the FTC now, alleging the software company violated consumer protection laws by making it too difficult for consumers to cancel their subscriptions. In response, Adobe saying, our priority is to always ensure our customers have a positive experience. We are transparent with the terms and conditions of our subscription agreements and have a simple cancellation process. We will refute the FTC's claims in court. So we got a fight in our hands, Julie. Bloomberg, by the way, Bloomberg cites an FTC official saying Adobe trapped customers into year-long subscriptions through hidden early termination fees and numerous cancellation hurdles. But you heard Adobe's response to it. They're clearly putting up a fight and going to court on this one.
Yeah, I mean, we've all had the experience of having a hard time canceling subscriptions for various things, and there are rules in place to try to prevent that from happening. I saw one report that if you have the suite of apps that Adobe, Photoshop, et cetera, $700 is around the cost that you can incur. And according to the FTC complaint, it has to, at least partly to do with when you cancel. In other words, if you sign up and you don't cancel within a certain period of time, then you can get sort of a prorated penalty. You can't get out of it easily. Again, that is what the FTC is alleging here. It was a 2010 consumer protection law that set the parameters for all of this that was designed to protect online shoppers.
And I had read, Julia, that actually Adobe had disclosed late last year that the FTC was investigating subscription practices, so not a huge surprise here, I think, for the street.
Right, exactly. Although we don't always know what the outcome of this is, and now we know, in this case, what they're going ahead to try to do.
All right, final one here. Check out shares of Virgin Galactic that continue to slide. It's coming after the space company's 1-for-20 reverse stock split taking effect today. So we discussed this one, Julie. Obviously, the company founded by Richard Branson, reverse stock split, which we discussed. The company looking to keep the stock price higher so it can meet certain requirements to stay listed. And the issue here is, I think maybe investors understand that probably things aren't going so great often if you have to make these kind of moves, and you can see the reaction there.
Yeah, I was looking at this sort of historical trajectory for the company. Remember, it came public in 2019. It was a de-SPAC, right? A special purpose acquisition company. So it came public through that kind of vehicle that was very, very popular sort of in the early days of the pandemic. The record price for it was $55.91 in 2021. So obviously it's come way down from there. And so on Friday, the board voted to authorize this 1-for-20 reverse stock split. And today it became effective. That's why you're seeing the stock price is higher than it was on Friday. And as you say, if a stock trades below $1 for 30 days, it is then sometimes, depending on the exchange, eligible for delisting. So that indeed is what this was aimed at stopping. And as we talked about the other day too, the company has paused its space flights because it's trying to now develop a new plane. And so investors aren't going to get anything from it for a little while in terms of news.
By the way, Barron's reminds me that Barnes & Noble did a 1-for-100 reverse split. So textbook sellers, space tourism companies, it's a trend.
They share a lot in common, apparently.
Still to come, as the AI race heats up, could Dell be a major competitor in the hardware space? We're going to break it down in our call of the day on the other side.
Federal Reserve searching for more confidence before starting the rate cutting cycle. Minneapolis Fed President Neel Kashkari hinting at December as potentially the time for a cut this year. And Philadelphia Fed President Patrick Harker said one cut by the end of the year is now his base case. But as the central bank awaits more data to inform future policy decisions, the risks to waiting begin pulling into focus. Former Chicago Fed President and CEO Charles Evans is joining us now to discuss. Charlie, thank you so much for being here. So there's a lot of chatter about this now and about the balance of risks here. What is your outlook for how many cuts we could get this year?
Yeah, sure. It's a very interesting situation. The Fed has been looking for inflation to come down now for quite some time. I mean, in 2022, inflation hit 9% on the CPI, 7% on the PCE, and it's much too high. That's what every Fed participant says. And so they're looking to get it down to 2% sustainably. And they've made great progress recently, and labor markets have continued to be quite strong. And so with core PCE at about 2.75 right now, there's still a ways from that 2%. So as you just mentioned, 2%, two participants just today sort of indicated one rate cut this year is what their baseline is. They're looking to have more confidence that inflation is going to start coming down from 2.75 to 2%. And that's the hard part. And so they're going to be looking for more months of improving inflation before they even really talk about, I don't know, should they cut rates in December or what?
And what did you think there, Charles, just in terms of your own timeline? I'm interested because you saw Neel Kashkari over the weekend on another network, Charles, and he was suggesting, it's reasonable to think maybe the Fed now, waits until December. Does that sound like, the timeline that makes sense to you, Charles?
Well, I was not surprised that the median SEP for 2024 was only one rate cut this year. The FOMC has been talking uniformly about how they need more confidence. Confidence is what they need. They are not very detailed. They are not detailed at all in what it takes in order for them to become more confident. And so it's this currently, somewhat opaque process as to how many good inflation reports are they going to need to see before they say, okay, I think we're finally going to get down to 2%. They have the benefit of a strong economy right now. The unemployment rate is 4%. Historically, that's quite low. And the funds rate's at 5.3%. And they must be asking themselves, why should I cut rates early until I absolutely know that I'm going to get down to 2%? The economy is not really struggling. It is not struggling because of this, although individuals, of course, are struggling with higher debt interest costs.
Well,
so I think, I don't know how many good inflation reports they're going to need to see, and I don't know for sure if the most recent good inflation report is going to continue. I'm hopeful that that's the case. And if it is, maybe they start thinking earlier than December. But right now, December looks like the modal bed.
And it definitely seems as though Federal Reserve members right now are by and large more concerned about a reacceleration of inflation than they are about a slowing of the economy. But we last week had the chance to talk with Allianz Chief Economic Advisor Mohamed El-Erian, and he is not so convinced that that's sort of how the balance of risks are looking. Listen to what he had to say.
So I think Chair Powell is correct in pointing out that there are two tails to the soft landing. The soft landing is what he's targeting, but there are risks on both sides. I think what he misses is the balance of that risk, that the balance, unfortunately, is in favor of them being too late and the economy slowing more than it should.
So I'm curious, Charlie, if you think that the Fed is appropriately cognizant of that risk that Mohamed outlines.
Oh, I'm confident that they are cognizant of that risk. I mean, Jay Powell has gotten that question at press conferences, and he has said we are mindful of our dual mandate responsibilities and whether or not the labor market is going to soften, whether or not demand is going to soften. At the moment, there's not enough evidence that that is actually happening. Now, that does seem unusual because the funds rate has been at 5.3% for quite some period of time. And interest costs are higher. And so that must be getting in the way of some investment opportunities that businesses would like to undertake. But they really are committed to getting inflation down to 2%. They are undoubtedly embarrassed by the fact that inflation went up to 9% on the CPI, 7% on the PCE, and it's their job to get inflation down to 2%. They don't want to get stuck at 2.75%. I would say that the risks are not that, the most likely risks are not that inflation is going to reaccelerate. The most likely upside risk is that it's going to stall out, that it's going to require a softening economy in order to get inflation down. I think they're mindful of that. They're looking for softening. And if they get it, then they're going to sort of try to split the difference probably. But they're really committed to getting inflation to 2%. That's a very stiff performance bar. And I think that's perhaps what made Mohamed El-Erian a little bit nervous, that because they're focusing on that, they might not pay attention to the softening. I'm pretty confident that the FOMC is going to be mindful of all of those things.
Charles, another question I got for you, switching gears a bit. Retail sales tomorrow. Charles, interested to get your general take on the American consumer. How healthy, how resilient do they look to you?
The consumer's been surprisingly strong. They've been resilient throughout, this episode. I think that the high inflation has taken a toll on households. That's absolutely the case. That's what every FOMC member says for quite some time. I would say that, at the lowest income groups, they have seen stronger wage growth in part to make up for the high inflation. It's still the case that food prices are high, gas prices are high, unaffordable housing continues to be highly unaffordable. But the skew in income inequality, I think, has sort of probably left us with stronger consumer, a resilient consumer because of that. And it undoubtedly retail sales will soften at some point because of the higher interest rates. That's part of the Fed playbook over some period of time. But at the moment, looking at the economy, it still looks resilient. It still looks strong enough. It looks like a soft landing in terms of the economy being at trend growth. And no evidence yet of the unemployment rate moving materially above 4%.
Charlie, thanks so much for your insight. Appreciate it. Former Chicago Fed President Charles Evans, thank you.
It's good to be here.
Time now for our call of the day. It's on Dell Technologies. It's getting a lift as Morgan Stanley reiterates its top pick status on the stock, noting that Dell will remain an outperformer this year. The shares are up some 6% here. And the company has a $155 price target from Morgan Stanley. The analyst over there, Eric Woodring, talking about meetings that he and his team had with management here. And he says those meetings reconfirm the company's competitive advantages. He talks a lot also about the company doing well in terms of cloud service providers, that they are going to be the main core demand driver for Dell's AI servers. In other words, cloud service providers are their clients, and there's a lot of demand for Dell's servers right now. And so that's helping the company's numbers.
Yeah, this is a very bullish note. I mean, Morgan Stanley went out there to Texas. They met with management, clearly liked what they heard for a number of reasons, really. I mean, they talk about how, hey, listen, bottom line, they look at AI server momentum. They think those concerns about AI server margins, Julie, remember, we were talking about that after they reported. They think those are misguided in their words. They see a path to higher margins over time. They talk about better storage execution, and PCs, they say, are on track to benefit from enterprise refresh. And just given Dell is over-indexed the commercial market, they think that's going to be one of the key beneficiaries. They will be one of the key beneficiaries of that kind of enterprise PC refresh they expect later this year into next year. Yeah, and Dell has already been a beneficiary. To be clear here, the stock is up 88% year to date, which is pretty incredible. I mean, I find it so fascinating, some of these sort of old tech companies that now are reinvigorated because of the AI wave, if you will, and Dell is one of the prime examples. Yeah, Dell has a great AI story to tell, and clearly investors are really buying it. And Morgan Stanley is saying, listen, they would take advantage of recent post-earnings underperformance, buy the dip, they said, on what they say is a leading AI infrastructure player. So very bullish note. Target's 155, although they even outline a bull case where their target, they say, could go to 200. Yeah. So big fans.
Yes.
All right, moving on. Paper and forest products getting a bullish outlook on Wall Street. Bank of America raising its forecast across the sector and lifting Greif to a buy, citing a better outlook and corrugated trends. Here with more is BofA Securities Senior Paper and Packaging Analyst George Stafos. George, it is good to see you. So you cover a lot of interesting names, George. You know, you got some consumer, it looks like, some industrial. You do also cover these areas like containerboard, like corrugated. Maybe just start there, George. What are the trends you're seeing in those areas, just in terms of growth, backlog, pricing?
Sure. And first of all, thanks for having me. It's a pleasure being here. So why should anyone care about the corrugated box market? Basically, 80% of the economy moves through corrugated boxes. And even though the economy is progressing, we've been going through a packaging recession, as you've been destocking and for other reasons, really since the second half of 2022. We've been doing a survey of the independent box makers to get a check on the packaging markets and the publicly traded companies for the last 20 years. And that data, both our survey and coming out of industry data, has been pretty negative really since the second half of 22. Even through the first quarter of this year, volumes were relatively flat off a very easy comparison. Last year, first quarter, box shipments were down 8%. So that's your setup. In our survey, we saw a very large pickup in the growth expectation for the next 2 quarters out of the independent box makers that we survey. We went from a 0.6% growth outlook to over 3%, which in my world, that's significant. Additionally, what we're hearing from the respondents is an overwhelming sense that prices would continue to move higher. It's mostly driven by costs, a lot of inflation in the cost structure, but nonetheless a view that prices would continue to head higher. And then also in some of the data that we look at, there is some encouraging things, not to say that it's all black and white positive, but amongst other things, we saw a little bit of an uptick in the outlook for e-commerce for the survey based on what we're getting from the independents. As a result, we raised our forecast 2 to 4% on pricing and on earnings as well. And we talked about the companies that are affected. Packaging Corp is rated a buy. It's been probably the best performing containerboard company over the last 2 decades. But Greif, which is part industrial packaging, part paperboard, and within their containerboard, they've been lagging. They're down 20% year to date versus the market. We think their trends are getting better. We think there's 30% upside, and hence the upgrade today.
And just to get you to elaborate a little bit on some of the driving factors behind this, you mentioned inflation, you mentioned maybe an uptick in demand in e-commerce. Can you dig into those factors a little bit and sort of what we have? I mean, because we've been seeing inflation, right? So was that not, but then the deceleration in inflation, is this a sign that maybe there's a reacceleration in certain areas? Talk me through that a little bit.
Yeah, well, certainly we can talk to what we see in our sector. Let's take the demand sector first. Okay. So box shipments, which usually move along with the economy, are at 2016 levels. So the economy's been progressing, but box shipments themselves have been not moving. Now, what goes in a box? Basically non-durable goods, food, beverage, consumer products. And so logic would say there's been a lot of destocking that's been occurring, and we've been certainly reading about that over the last number of years. So the fact that you're seeing an uptick suggests that maybe consumer demand is still relatively good, and maybe there's some shipments now as you're seeing some restocking. On the pricing front, prices went up, round numbers, $200 a ton, over 20% between the fourth quarter of 2020 through the first quarter of 2022. Okay, and then you saw prices decline as there was a slowdown as we went through that destocking period, as we were saying, that recession, about $100 per ton. Meantime, costs are going up. Labor, freight, and the cost of fiber. One of the things that's very interesting about the packaging sector and containerboard is there's a lot of recycled fiber. It's a green market. Recycled fiber has gone up, when you consider transportation premiums, as much as $100 per ton. So the containerboard companies are raising pricing now to offset inflation that they're seeing in their cost structure, and hopefully because demand is picking up as well.
George, let's get some picks here for people too. So we mentioned how you like Greif, ticker GEF stock. It looks like it's in the red this year and over the last 12 months, but you obviously see better times ahead, George.
That's correct. The stock is down about 20% year to date relative to the market. Obviously, the market's been a tough comparison for a lot of sectors. Greif is a leading producer of industrial packaging. Think metal drums, plastic drums, bulk containers. That's, call it half the business. But they also have another half that's in paperboard. One of the portions of their paperboard business is container board and producing corrugated that goes into ultimately making corrugated boxes. Now that's been under pressure, largely because of inflation. You did see sequentially better trends coming out of their fiscal second quarter, which they just reported. And so based on our research, based on our data, we think that sequential trend will continue to improve into the second half for them.
George, thank you so much. Interesting stuff on your industry. Appreciate it.
Thanks so much for having me.
Coming up, the tech sector getting a lot of love from investors. Is it time to shake things up? More market domination on the other side.
A rebalancing is in order for one popular tech sector ETF. This is according to Spiders America Research. For more on what will come of these changes, let's get right to Yahoo Finance's Jared Blickery. Jared.
You know, we look at the screen quite a bit, but I don't always break it down. This represents 11 different large cap sectors and the ETFs that represent them for the S&P 500. That would be large cap stocks. And today we're talking about XLK. And in fact, that is the #1 performing sector this year in the S&P 500, XLK. This contains Apple, Microsoft, Nvidia, and many of the chip names that we have seen outsized performance for this year. But something interesting has happened because of the outperformance of not only Microsoft, but also Apple and Nvidia. They've done so much better than the rest of the market that we are now facing market concentration issues with respect to the makeup of XLK. So if you took a look at the S&P 500 Infotech performance going back, let's say, to October of 2022, there is a huge disparity between the performance of the theoretical index value and XLK itself because of this. Now, currently, Microsoft is making up 22% of the index, right there you can see. Apple is 21%, and Nvidia is only 6%. But if without these rules, we would see each of those numbers closer to 20. So because of what happened last Friday, that's Nvidia closing higher than Apple with a bigger weight, we are going to have them switch place in the index. So Apple is going to go from 21% of the index all the way down to 5%. Nvidia is going to go from 6% all the way up to 20%. And this represents some pretty big dollar movements. So that's going to be $11.4 billion worth of selling for Apple, which represents an entire day on average, and about $10 billion gains, $10 billion in buying for Nvidia. That's about 1/4 of the daily volume. Enough to say that it could cause hiccups in the market, except to say that this is very well telegraphed, and the rebalancing is expected to happen on Friday. It's quite possible that we've already seen the market moves that have kind of representative, and that's because we saw an Apple that closed down on Friday afternoon, and that was something that was anticipated. So the bottom line is investors are probably ahead of this in this one, but I think it would come as a surprise to many investors that they have been underperforming their benchmark index. That would be the S&P 500 technology index by such a large degree because of these kind of archaic concentration holdings and archaic concentration rules that are in effect and that are now being applied. I hope that clears everything up.
Yeah, really interesting and comprehensive look at this whole process, Jared, and why it's important. Also, a lot of money follows this stuff. Thank you. Tech is on a hot streak, as we have discussed frequently. The Nasdaq Composite hitting intraday highs after notching a perfect week in Friday's session, 5 straight record closes, while tech giant Apple maintains its weekly streak of gains as well. We're looking at how to navigate the big picture with the Yahoo Finance Playbook, and Doug Clinton, managing partner at Deepwater Asset Management, is joining us now to discuss. Doug, it's good to see you. We continue to see these sort of mega cap tech giants continuing to climb here. I know that you watch them closely, but you also watch a lot of the sort of ones that maybe we don't talk about every day. So just big picture here, are you feeling like things are getting overstretched, or do you feel like there is a lot more upside?
We do still feel that there's more upside. And the bottom line for us, Julie, is we still think we're in the relatively early innings of this AI-driven bull market. It may feel like we're late in the cycle here, and we actually just did a survey, 1,300 people on X. Almost 90% of respondents either said they think we're already in a bubble that's about to keep going or crash, or that we're not in a bubble yet and we're going to get one. And so the bottom line is it feels like the market is really attuned to the realities of AI right now. And our view is that it is still early. The way to position yourself for it, though, is I think where you can kind of add alpha and prepare your portfolio properly. What we like to do at Deepwater is invest in both the public and private markets. On the public side, we really like the hardware space. It's been the outperforming space, the best performing space of the year. We still think there's a lot of room to go in terms of AI infrastructure spend that's still to come. On the private side, that's where we're getting our AI software exposure, because that's where the pure play AI companies like a Databricks, like a Hugging Face, and like XAI, which we just recently invested in at Deepwater, that's where you can find those types of investments.
And hey, Doug, in the public markets, some of these AI hardware names, Doug, Arista, it's had such a, that's had a strong run already. Doug, would you be adding there, or maybe waiting for a pullback at this point?
We do own Arista, Josh. We still like Arista, and it actually had a great week last week. On top of those Broadcom earnings, Broadcom talked about strong networking demands, and they actually upped their networking revenue guidance on the reality that there is strong demand for Ethernet-based products in AI data centers. Arista has built their portfolio around Ethernet, and so I think they stand to be a good beneficiary of that trend that we're seeing from Broadcom.
And also, what strikes me as I looked at your various picks, whether you're talking about Arista or some of the memory chip makers like an SK Hynix, like a Micron, is that, for lack of a better word, they're sort of the less sexy areas. That, in other words, they haven't gotten as much attention, right, during this whole situation. Does that mean, whereas, the stocks have still done well, but do you think that they maybe are more attractively valued than some of those that are getting more attention?
I think some are, and I think what's even beyond that is if you think about kind of what's been priced in so far. You look at a stock like Nvidia, obviously they've had incredible earnings growth that has supported how that stock has moved. I think companies like an Arista, Vertiv is another name that we like that does liquid cooling solutions. I think those are stocks that actually still have upside to numbers. And that's really what we're trying to find as we look beyond the big cap names like the Nvidias, like the Broadcoms. We want to see that there's still potential that hasn't been fully recognized yet by the market. And I think that makes these stocks actually probably cheaper than they might appear if you just look at the numbers.
And Doug, I haven't had the chance to talk to you since Apple's big software show. I'm curious to get your take, Doug, because the narrative there heading into the show, at least in some quarters, was, well, Apple's fallen behind in this AI race. And Tim Cook obviously tried to take the stage and really kind of change that narrative, change that story. Doug, do you think he did it?
There's two sides to it, Josh. It's hard because if you're an AI nerd like me, you probably weren't blown away. We didn't see anything from Apple, if you're really closely following the AI space, that we haven't really seen before from Google, from OpenAI. And so I wasn't blown away. But what I think is important, more important, is that the average Apple customer, the person who doesn't care about ChatGPT, maybe doesn't even use it on any regular basis, I think they probably saw some features, for example, a Siri that might actually just work for once. I think that is a big deal for the average Apple customer. When you think about customers that need to upgrade and really drive device growth, where we haven't seen that device growth from Apple for the last kind of 18 months or so, I think those are the customers that matter. And I think Apple probably did enough with AI to excite them to come and get a new iPhone over the next year or two with these AI features.
So were you one of the folks buying Apple shares sort of the day after the beginning of the presentation as we saw the stock surge to a new record?
I couldn't speak to kind of recent trading activity for us, but what I would tell you is this: on the large cap side, for this whole year, really Google and Meta have been our two favored names. And the reason is because they both are leaders in the AI generative model space. I think there's only 4 companies really that have a chance at creating artificial general intelligence and sort of winning the AI race. It's OpenAI, it's Google, it's Meta, and it's xAI, Elon's company that, as I mentioned, Deepwater did actually invest in that one as well. We think that's a good space to deploy capital to.
Well, and I think that's a really interesting point, because a lot of people don't necessarily have access to, you talk about that on the software side in AI, a lot of the exciting stuff is happening with still private companies. So what can people who maybe don't have access to those raises, how can they get access? Or, as you brought up earlier, is it better to sort of play on the vendors maybe to those companies?
I think that's the easy answer, is you want to probably look back to some of those hardware companies and maybe wait until some of these AI companies come public. Or if you do have access, if you have a vendor that you can work with to get access to private markets, that might be something worth exploring too. But I think the easiest path is, and I do think the window is open right now for a lot of these AI companies, is probably to wait for them to come public. And I do expect we'll see some of that happening over the next 6 to 12 months.
Doug, always great having you on the show. Thanks for coming on, my friend.
Thanks, Josh. Thanks, Julie.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
That's the closing bell on Wall Street, and now it's market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. We start with where the major averages ended the day. Pretty steady here for the Dow in the last couple hours of trading here with a gain of about 190 points. That's a gain of 0.5%. The S&P 500 back at a record here, up about 3/4 today and closing higher, substantially above 5,400. As we talked about earlier, we have a number of Wall Street strategists coming out and raising their targets for the S&P, most notably, or the highest, from Evercore ISI's Julian Emanuel at 6,000. That's where he is putting the S&P 500. The Nasdaq also closing at a record again today, and that makes it, I believe, 6 sessions in a row that we've seen those records. Here's the 10-day look at the Nasdaq, up 6% in that period of time. What's interesting to me about today, though, however, is that you don't just see participation of big cap tech. You also see the equal weight index of the S&P almost keeping pace with the S&P 500, not quite, but close, up 0.7%. And the Russell 2000, people still love small caps, even though we have still seen them underperform. But we still see a lot of folks talking about how they like the small caps, including Mike Darda at the top of the show from Roth MKM. That index up about 0.7% as well. So a couple things I noticed here. I'm sure Jared noticed a lot more. Let's go to him now for a closer look.
Well, I like that. Really interesting observation that you got the Russell 2000, the S&P 500, and the S&P 500 equal weight all up 0.7%. So maybe those concentration issues I was talking about a moment ago finally disappearing a little bit. I think they'll come back. But here's a sector action, how we close today. Consumer discretionary, that's XLY. That was number one, up 1.77%. Then you have tech, then you have industrials, all three of those over 1%. And to the downside, we got utilities down 1%, then real estate and healthcare as well. And if we take a look at some of the leaders here, you can see a lot of green, not a lot of red. So what did poorly? Solar energy, that's that TAN ETF, IB IBB is biotech, and LQD is safe U.S. Treasury bonds. A little bit boring there, but you don't have to worry about that today. We got gambling in the top spot, up 3%, followed by cannabis, New York FANG. That's a lot of these chip stocks that we're talking about. Bitcoin, regional banks participating. So let me just skip over to the semiconductor heat map, and you can see Nvidia taking a little bit of a tumble. But check out Broadcom to another record high, up 5.4%. Guys.
Jared, thank you. Markets closing the day with gains across the board and new records for the Nasdaq and S&P 500. It is the 30th new high of the year for the S&P, and some may consider taking some cash off the table. But our next guest says it's important to stay invested. Joining us now is Tim Urbanowitz, Innovator Capital Management, Head of Research and Investment Strategy. Tim, good to see you on set, live.
Great to be here with you, Josh.
Let's start here. Interesting headline in the Journal. I want your take on, Tim. It says, here's the headline, ready? Investors fear long stretch of calm in markets can't last. With stock indexes at record highs, they say market volatility has been exceptionally low. What do you make of that, Tim? Give me, with all this calm, how nervous should I be, if at all?
Well, it's been an incredible run, and on average, right now we're hitting a new all-time high every 4 days on the S&P 500 this year. That is significant, and this is actually the number one conversation we're having with our advisors right now. Everybody's getting a little bit nervous.
So even though it's all good, there's this undercurrent of some nervousness.
It feels like that, and what we continue to remind our advisors is that the all-time high is not a catalyst for a sell-off. Never has been. Never will be. In fact, quite the opposite. It tends to be a very good time to be invested in the equity market. If you look at all-time highs historically, the average 12-month return that we see after that all-time high is right around 12%. 77% of the time, we're positive. Okay, so that's significant. You also tend to see these all-time highs, they tend to be clustered together. So what we're seeing right now every 4 days is not abnormal. You look at the stretch from 1989 to 2000, every 9 trading days, we saw a new all-time high. 2013 to 2022, every 8 trading days. So not only is it not a catalyst to be out of the market, right? You have to be in the market. It's a good time to be invested. You got to stay in despite the concerns.
Okay, so let's take the other side of that then. Why should you be in? Besides just like things tend to go up, which they do over even, I mean, you look over the long term as well. Stocks go up, as we like to say here, kind of tongue in cheek. But what are the fundamental reasons that people should be still invested?
Well, I think the fundamental reasons are a little bit different. You'll get to that in a second. I think right now, the next 3 to 4 months, it's all going to be about this immaculate disinflation narrative. The pause is a very profitable time to be in equities. It's all about investor sentiment. Everybody gets excited. It's been all about inflation this whole time. Once you start to see some relief, once it looks like the Fed is going to get to that cut, it tends to be very profitable. And I will say that even when the fundamentals are not going to be good moving forward. If you look at the last 4 hard landings, there has been a time when short-term rates peak where it's always profitable to be in. In fact, the S&P 500 runs an average of 20% after short-term rates peak, up to 47% in some instances. So regardless of what's next, regardless of what the fundamentals might look like, regardless of what the economic outcome might be when it's all said and done, right now is very important because all investors are always focused on that disinflation narrative, but it gets a little cloudy after that 3 to 4 month stretch.
Let me ask you, Tim, if you want to stay overweight equities, is your advice then just stick with what has been working? Is that what you're telling clients? So it's large cap, it's tech, AI?
I think you have to at this point in the game for a couple of different reasons. One, we don't think the interest rate conversation is in the bag like the market has it priced in right now. So you have to be cautious on that front. I think a lot of the big tech names, the Mag 7 names, have been doing very well despite rising interest rates. I look at that subset of securities. You're up 75% since the rate hike cycle starts. Clearly, rising rates, higher rates is not an issue for these names. So you really hedge yourself from that perspective with that risk. But you also got to remember the other side, we still don't know what the end game is going to be. When we have inflation coming down, you have disinflation, right? Companies have been able to keep margins up. They've been able to keep profits high because they've been increasing prices as prices have been going up. Now that narrative is starting to shift, and you're going to have to look for other ways to protect margins, protect revenues, right? And is that layoffs that could start to have an impact on the economy? So I look at other pockets of this market. Small caps, yeah, they look cheap. They could be a good place to be if we have this soft landing, but that's not in the bag. They're going to get hit with higher rates. They're going to get hit if we see the economic downturn. So I think it's much safer to stay in those larger cap names that we've been seeing working so far.
I mean, we have seen some research that shows that the sort of premium that those names are getting, though, and that they're earning also may start to shrink here. Do you think that is a risk?
I think it's certainly a possibility longer term, especially when I look at a stock like Nvidia. Is the assumption that they're going to keep a 70% margin moving forward? That's going to be very tricky in a society that's not monopolistic, right? So I do think you have to broaden the horizons a little bit. But in the short term, again, where you have those risks on both sides, we think you got to stick with what's been working thus far.
And Tim, I'll get you in this. One theme that's bubbling up, you're noting, is clients maybe getting a little nervous. Yeah. Another thing I'm just interested in, we are in election year, first debates coming up. Has that been kind of bubbling up too, where clients asking more about that now? And if so, what's your advice, what's your guidance?
We're starting to see it pop up more and more. Typically, when you look at 2016, 2020, the volatility spikes happens a little later in the year. So my guess is you're going to see that bubbling up in the next couple of months. But regardless, we still have clients asking. Obviously, there's going to be a lot of differences in policy. You look at traditional energy companies doing well under a Trump administration. The green energy, clean energy companies really having a little bit more of a difficult time. What we're encouraging clients to stay focused on right now is really the consistencies of what both administrations might look like. And the one thing that is consistent, like we saw over the last two terms of these presidents, is that they like to spend money, right? And in our view, that is going to keep pressure up on interest rates. And you need to be focused on that. You're going to be spending. It's going to help keep the economy going, in our view. So you got to focus what's known right now. And as we get closer, we start to see what the polls look like. You're going to see more of that uncertainty, that volatility kicking up.
Interesting. I was going to ask, what could possibly both sides spending money? That's
what they both like.
That's the thing. Yeah. All right, Tim. Good to see you. Thanks for coming into our studio. I appreciate it. Well, that's a perfect segue here because as voters prepare for the presidential debate season to kick off next week, one thing that will be top of mind for some Americans is expiring tax cuts. President Joe Biden and former President Donald Trump have both suggested they would extend the deadline for some Americans, but is that the right move? Yahoo Finance's Rick Newman joins us now with more. Speaking of spending money, Rick.
Hey, guys. That's right. The battle is underway over the tax plans. And a lot of interest groups are getting in on the act here. So when Trump did those tax cuts in 2017, they went into effect in 2018. Those ended up costing about $1.3 trillion. That's about how much they added to the national debt. So when Trump did that, the national debt was only around $20 trillion. It is now $33 trillion. And the latest analysis on what would happen to that number if all of these tax cuts stayed in place, it would the national debt, it would add about $4 to $5 trillion more to the national debt. So you can make a pretty coherent argument that we just can't afford to keep all of these tax increases in place. Now, it's important to break this down because there are a bunch of different things here. What expires are the tax cuts for individuals. The tax cuts for corporations, that was lowering the corporate rate from 35% to 21% and a bunch of other changes. Those don't change. That is permanent. However, President Biden has said since he was running for office in 2019, he would like to see a higher corporate tax rate. So, there's going to this really matters not just who wins the election, but who takes control of Congress in this year's election. That is going to determine how this negotiation goes and what happens at the end of 2025 when those individual tax cuts expire. That is probably the biggest policy issue looming that we know about.
And Rick, sticking with taxes, the IRS aiming to close a loophole used by some. What's the plan there, and what could come in?
Yeah, this is for certain businesses. It's complicated. We're not going to get into the details, but it has to do with how you depreciate assets. And if you sort of transfer things from one column to another and you have expensive lawyers and accountants who know how to do that, you end up paying a lot less additional tax for certain types of businesses. Now, let's go back. When Biden signed the so-called Inflation Reduction Act in 22, that included $80 billion in new funding for the IRS, and $60 billion of that is still there. They had to give up $20 billion as part of a different deal last year. But that extra money is for better enforcement. It's for hiring the experts who can go toe-to-toe with expensive corporate lawyers and corporate tax accountants and hang in there in the courts and fight these battles. So the Biden administration wants to make this policy change, but it really takes that extra money for the IRS to do it. So if you feel like businesses are kind of like putting one over on the government and not paying their so-called fair share. I think you want greater enforcement because this is where the tax avoidance really is. It's not working people who are avoiding paying taxes, and there's no sign that the IRS is using that extra money to go after ordinary people who just go to work and have tax taken out of their paycheck. It's these complicated corporate structures that have a lot of opportunities for avoiding taxes. So the IRS is trying to claw back some of that money.
Rick Newman, thank you, my friend. Appreciate it.
Bye, guys.
Eli Lilly has unveiled its newest plant, which will help relieve manufacturing bottlenecks for GLP-1 drugs. Take an inside look when market domination overtime returns.
On Friday, Eli Lilly unveiled its newest manufacturing plant in Concord, North Carolina, which the company says will help relieve manufacturing bottlenecks for GLP-1 drugs. Here with more, Yahoo Finance's Anjali Kamlani, who got a first-hand look at the plant. There is a lot of demand for these drugs, as we know, and one of the only limiting factors has been supply.
One of the limiting factors has been parts of the supply chain. So that, yes, the supply chain is the problem. And so what Eli Lilly is doing is, in unveiling this plan, they're talking about one part of that, which is the injectable pens. That's one of the key shortages, as well as, of course, the drug product itself. So this specific plant is going to be helping with the relief on those injectable pens. The company expects this plant, which is 1 million+ square feet, to be live by early next year, so 2025. So this is not even something that we're going to see within the next couple months. It's something still as a next year timeline process. We did get a chance to look inside. There's some really interesting things that they've sort of stood up. They're looking at how to make it more efficient, faster. So that includes, robotics as part of the process. So automating parts of the process where humans are not necessarily needed. That's one of the areas. And we do know also that they were able to stand up this building in basically about 2 years. 5 years is about the average for a plant like this, of this size and magnitude, and they were able to do it in 2 years. They also doubled the amount they were investing, initially $1 billion, increasing it to $2 billion. So that says a lot about how much the company is really looking to invest in not just this, but other plants as well. And that's an important part to remember. This is just one of the plants of about 7 total that the company has planned. And I will let you listen to Edgardo Hernandez, who is head of manufacturing at Lilly, tell you a little bit more about that.
We have announced $18 billion of investment since 2022 today. So we're building 2 facilities here in North Carolina. There's 2 facilities that we're building in Lebanon and north of our facility in Indianapolis. We also announced investments in Ireland as well and in Germany recently. And also, as you probably know, we announced the acquisition of a facility in the Kenosha County in Wisconsin as well, which is part of our parental fleet of facilities.
So as you know, the race to get more manufacturing is one of the problems, not just Eli Lilly, but its competitor Novo is also facing. Novo, we know, of course, the parent holdings company did acquire Catalent, or is it trying to acquire Catalent manufacturing plant. So they're really, double-sided efforts to try and get more international manufacturing as well online in order to feed this craze.
All right, Anj, thank you for the update. On Friday, the National Association of Realtors will release its monthly snapshot of existing U.S. home sales. Economists project sales of previously occupied homes fell in May for the 3rd month in a row. Spring home buying season off to kind of a sluggish start this year as home shoppers contend with elevated mortgage rates and rising prices. And joining us now to discuss is Lance Lambert, Resi Club co-founder and CEO. Lance, it is good to see you, and it's been a bit since we spoke to you, since I had you on the show, Lance. So it's good to see you and get your take on all things housing. It feels, Lance, like some of the same big trends are in play here, meaning, it seems like the demand is there, but, on the other hand, affordability is still an issue for a lot of folks. But you tell me, how does it look from your perspective?
Yeah, affordability, supply. That's the story. And we are in one of the periods with the fastest affordability strain ever in terms of going from 2021 to now. That's a historic deterioration in affordability. And that rate shock at the end, going from 3% to 4% to 5% to 6% to 7%, really just strained affordability. And so the market still doesn't have a ton of churn occurring, turnover. Think someone who has a home who's like, you know what, I'm going to sell this and go buy something else. That's the piece of the market that's been missing. We still have the deaths. We still have the divorces. We still have some of the first-time home buyers out there struggling. But it's that churn that's been missing. Now, we are starting to see some of that slowly come back into the market because at the end of the day, people can only put off the move so long. If you have more kids, if there's a lifestyle change, you have a job in another market, you start to get pulled back into the market. And we are starting to see those new listings slowly move back up as the lock-in effect eases, but we're not seeing a response in existing home sales. We're not seeing that also jump up. And so what that means, that gap there is rising inventory. And so the actives in the market are slowly starting to rise. And that will mean that in some markets, it could begin to soften price growth. And that's needed because in these Northeast markets and the Midwest, there hasn't been much relief at all, despite mortgage rates going so high. And so those markets need inventory to get up. And in the Southeast and pockets of the Southwest and around the Gulf, you could see a little bit of softened price growth and even some slight declines in parts of like Louisiana, Southwest Florida, the condo market in coastal Florida, and patches of Texas.
Well, and Lance, it seems like we're maybe starting to see some of that already. Liz Ann Saunders over at Schwab flagged some Redfin data today that showed that 19.2% of the homes for sale in May actually had a price cut. which is quite an increase in the number of price drops that we have seen. So is that a good leading indicator, or how would you read those numbers?
Yeah, that's not too out of the ordinary. You know, we are at the peak of the spring season, and so some of the people coming into the market at this point, they've just come in with higher expectations than they should have. And the next several months, you know, some of them, you know, might have to lower their expectations and cut list price a bit to be able to sell if they want to sell before we really get into the fall period of the year. But are we seeing a huge jump in terms of falling prices across the country? Not really. Not yet. You know, we still have year-over-year home price growth. It could begin to start to decelerate as inventory continues to push higher. But in terms of a steep decline in prices, we're not seeing that right now nationally. Although we are seeing some softening, and like I said, pockets of Texas, areas in Louisiana, around the Gulf into Southwest Florida, those markets where not only did prices go up a lot, not only did mortgage rates go up a lot like everywhere else, but they're also seeing these home insurance shocks. And then the condominium market in Florida has another shock, which is that Surfside condo collapse back in 2021. And now there's a bunch of regulatory changes that have happened into the market that's really putting downward pressure on those older existing condo buildings down in Florida, around the Gulf, around the coast.
Lance, let's say the Fed cuts in September. What kind of impact would that have on the 30-year fixed, Lance? Which, by the way, according to Mortgage News Daily, I'm looking here, 7.04%.
Yeah, so a lot of these different groups like Fannie Mae, the Mortgage Bankers Association, Moody's, Goldman Sachs, Morgan Stanley, they all believe that mortgage rates, the average 30-year fixed mortgage rate, is slowly going to start to roll over closer to 6.5, 6.2, 6.3. If that actually occurs, that could be a bit of an affordability improvement. And that could also bring some of the turnover back into the market. Those people who were, you know, on the sidelines, didn't want to give up their 3 or 4 for a 7. Maybe as we get down closer to 6, or if we could get into the high 5s, they might be like, you know what, it's time to make the move. But again, that's speculation. We've been hearing for 2 years that any time now, you know, within a few months, mortgage rates are going to come back in, and it just hasn't happened. And so far, they've been fairly stubborn, closer to that 7 figure.
Lance, always good catching up with you and getting your insight. Appreciate it.
And anytime.
Time now for What to Watch Tuesday, June 18th. U.S. retail sales for May coming out in the morning. Economists forecasting sales to increase 0.3%. This coming after Americans halted their spending in April, giving us some more insight on consumers as they continue to battle inflation.
Meantime, outgoing Boeing CEO Dave Calhoun on the hot seat. He'll be testifying in front of a Senate subcommittee on Tuesday, focused on the safety culture at the aerospace giant. And it follows a new report from the Wall Street Journal saying the company is running into some hurdles finding Calhoun's successor.
On the earnings front, KB Home is reporting second quarter earnings after the bell. Analysts expect the home builder to expand home orders by about 20%. They'll also be keeping an eye on the company's outlook for gross margins, given that volatile rate environment.
And finally, Yahoo Finance's Jennifer Schonberger will have an exclusive interview with Boston Federal Reserve President Susan Collins. That will be coming up tomorrow at 4:40 p.m. Eastern. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The Nasdaq and S&P 500 notching fresh record highs with gains of more than 1% on the day. And as stocks move higher and higher, we're seeing Wall Street banks raise their year-end targets, 3 already just in the last day. We're going to take a deeper dive into today's market action and bring you the trading takeaways. Of course, one of the drivers of the rally, big tech. We're looking at how the sector is the backbone of the market's moves this year and the weighting in the S&P 500. And one investor telling us there is more upside ahead, that we're just in the early innings of this AI-driven bull market. And artificial intelligence is one of the key topics of conversation at the Cannes Lions Festival of Creativity. We're going to hear from Disney's top advertising executive on how the technology is transforming the business, plus the latest on the company's streaming efforts. After a challenging couple of years for initial public offerings, the IPO market is heating back up. And our next guest says that AI, IT, and fintech are the most popular industries among IPO investors. For more, we're bringing in Brianne Lynch, Equities and Head of Market Insight. Brianne, it is good to see you. So maybe we'll start kind of high level, Brianne. Just get your take on that U.S. IPO market. You would think, Brianne, listen, I mean, the stock market's working, the economy's decent, right? Inflation's moderating. It should be a good time to go public, right?
Yeah, absolutely. All of the key macro indicators suggest that now would be a good time, but we've really seen fewer IPOs this year than many people were hoping for. And the companies that we have seen go public are larger players, so they're raising more capital, versus smaller IPOs. It's been a mixed bag in terms of the outcomes. We've seen strong first day performance for a lot of these IPOs, like at Tempest last week, Reddit, Rubrik, Astera, all traded well on that first day of trading. But when we zoom out a bit, the overall IPO performance has been mixed. Renaissance's IPO ETF is trading slightly down on the year, so it hasn't been this mass call to other companies to join the market. And frankly, the strongest private companies have access to both liquidity and capital in the private markets, and they just don't need to IPO.
Yeah, that's actually interesting, Brian, because you've been covering, this space for a long time. And I was interested to get your take on that. Just, in terms of how the capital markets have sort of evolved and developed, Brianna, are there more companies just simply staying private for longer now?
Yeah, absolutely. And we're seeing that has been the case over the past 10 years, and it's certainly continuing to be the case. There's now about 4,000 publicly traded companies. That's down from 8,000 about 10 years ago. So when you look at the universe, or the investable universe for a typical investor, there's half as many opportunities. And that's because of the abundance of capital that has been available in the private markets over the past 10, 20 years. So companies are growing to be much larger, unicorns, decacorns, really leaders in their market by the time that they do go public. And it really raises the question of how much upside is left for these public market investors. And we've seen more institutional investors tapping the private market, seeing the opportunity there. And then our platform really trying to get more retail investors similar access as well.
Having said all that, Brianna, are there any companies right now that are on your radar that you think could take the public market plunge this year?
Yeah, one of the names that's been in the news, I think, is an interesting one to watch. It kind of checks a lot of the boxes that I think companies will need to show is StubHub. They're rumored to be eyeing an IPO this summer. This is a company that was founded in 2000, so a 24-year-old company, certainly not a young company, but they've generated $1.4 billion in revenue in the past year, EBITDA positive with $350 million in EBITDA. And this is a brand that consumers recognize. It's a business model that they can understand. So I think that will be an interesting one to watch. But zooming out from an industry perspective, AI is all the rage in both the public and private market. So I think the names that will get a lot of investor interest are those that have an AI component. And since a lot of these AI companies are still young, it's probably the infrastructure players or the chip providers who are going to be the next to exit.
That is interesting, Bram. We talk so much about AI in the show, and for good reason. There's so much excitement from investors. I'm wondering just how much pressure you think companies now feel like, well, if we're going to go public, we better have some AI story to tell. We better have some AI magic we can, sprinkle on the S1.
That's absolutely right. I think any company that is going to go public in the next 6, 12, 18 months is going to weave AI into their narrative one way or the other. So it's really for investors to decide if that's a key business driver for them or a key part of, what the future upside might be versus just kind of capitalizing on the buzz that's happening in the market right now.
Brianne, always good to have you on the show. Thanks so much for taking the time to chat.
Thank you.
And coming up, we're sending it out to the 2024 Cannes Lions International Festival of Creativity to hear from Disney's president of global advertising. We're asking for a trend on the other side. The S&P 500 notching its 30th record close of the year. The Nasdaq keeping the streak alive with its 6th consecutive record close. For more on the market takeaways, let's get to Yahoo Finance's very own Josh Schaefer. Joshua.
Josh, so we have more record highs for the S&P 500 and the Nasdaq, and we also have more bullish calls on how high the S&P 500 can go this year. So this is from the past couple of days. We had Evercore ISI out with the most bullish target on the street now at 6,000, up from 4,750. So you can see a flip there really from Julian Emanuel. We have Goldman Sachs boosting their year-end target to 5,600 from 5,200 earlier this afternoon. After these two, we had Citi follow, and Citi now went up from 5,100
to 5,600.
Yeah. 3 is a trend. We have a trend, and people feel better overall, right, about where the index is headed. A large part of that is due to sort of the mega cap exceptionalism, those big 6 stocks, the Microsofts, the Apples, the Nvidias of the world that we talk about, and how well those have performed. But another interesting thing, now that we're at record highs, we talk a lot about stocks being expensive, right?
Yep.
So the price to earnings ratio forward, we're looking at the forward PE of the S&P 500 here, above 20. That's what strategists would call expensive. We've been there for 143 days. And what the big takeaway from this chart for me is yes, you can talk to your financial advisor right now and they might tell you stocks are expensive. Stocks can be expensive for a long time. We were at this level for almost 2 years back at the end of COVID in that post-pandemic bubble. And then we were at that level for more than 2 years, over 700 days when you go back to the dot-com bubble. So my big takeaway from this chart being essentially, yes, you can look at a lot of sentiment indicators that are going to tell us we are stretched. They're going to tell us stocks are expensive, but that doesn't mean that the S&P 500 is going to fall 10%.
Good times
tomorrow.
can continue.
Good times can continue, and they can continue for longer than we expect. And that is why I think we're seeing some strategists come out and still be bullish even after all the gains we've had.
Concentration.
Concentration in the market goes with that.
A few winners and everybody else is lagging. Is that what we're hearing?
Yeah, when you look at the Mag 7,
Relatively,
Mag 7 contributions for this year to the S&P 500, again, those big tech stocks, over 2/3 of the gains have just been from those tech stocks. But when you look at the fundamentals, this is from Goldman Sachs, and they point out this is earnings revisions, so upward revisions to earnings over the last year. We're looking at 5 stocks here, Microsoft, Nvidia, Amazon, Google, Meta, 38%, and the S&P 500 is flat, and the rest of the S&P 500 is down. So if we know that earnings are the key driver for stocks in the long run, this number would tell me those should be the stocks that are rallying, right? So I think from that sense, you can sort of say maybe a fundamentally backed rally.
Yeah. I thought it was interesting, Josh, like if you were going to channel your inner bull and you would say, if I believed, the economy's in decent shape and I'm going to say, okay, I think it's going to continue, then you could make the case, well, if that's my thesis, then I would think, okay, there's a lot of potential catch-up that's just going to happen.
A catch-up, Josh, that is one of Goldman's scenarios. So Goldman says 5,600, right? That's right here in purple.
Yeah.
But if you look at yellow, that would be 5,900. That's a catch-up scenario. So that would mean big tech doesn't keep outperforming to an extended level, but the rest of the stocks kind of come with a strong economy. Now, you could also have the big tech exceptionalism we just talked about continue. More AI, we're talking about more earnings beats. That gets you above 6,000. And this is a growing case some analysts are seeing because we know Apple, Nvidia, those companies are continuing to surprise, right? Really, I should probably just highlight Nvidia there. Nvidia is surprising a lot, and that's driving things up. Also important to highlight within this, there's the catch down scenario, right?
Yeah.
So when we rely on big tech this much, if big tech disappoints, it could get us down here. And to your point to the economy, Josh, if the economy disappoints, then of course that might lead to lower earnings than we expect as well.
All right, give me the third Josh Schaefer point.
Our final takeaway is simple. It's the biggest thing to watch tomorrow. It's a
Big
slow
data
week
point.
of economic data. Tomorrow we have retail sales. We're looking for that number to come in at 0.3%. It was flat last month. And I think the key thing to really just focus on there is it was flat last month. Are we seeing the start of a trend? Or is that trend reversing and retail sales pick back up? Because as you can see, we haven't had a lot of months in the last couple of years where we fall consecutively. So if we're worried about that consumer, that's going to be a key number.
And basically, we've wrapped up earnings, right? I mean, what do you think? There was a lot of data points, a lot of conference calls. Everybody's trying to get their head around the American consumer. What's the Josh Schaefer take?
It seems, I'll tell you what the consensus is, right? Instead of my take. I'll rely on the people I talk to. But it seems like the economists largely feel like we are slowing down, but not entering a slowed down.
Cooling, not crashing.
Cooling, not crashing. So we'll look for signs of that tomorrow. Think about 0.3%. That's not impressive, but it's not bad and it's not negative.
You'll take it. All
We'll
right.
take
Thank you, Joshua. Moving on, the Cannes Lions International Festival of Creativity getting underway, and no surprise, artificial intelligence is front and center. Earlier today, our very own Brian Sazzi and Rochelle Akufo sat down with Rita Farrow, Disney's president of global advertising. Here's that conversation.
Joining us out here today is Rita Farrow, Disney's president of global advertising here in beautiful Cannes. So obviously we have this gorgeous backdrop, a lot of nature here, but another thing that's always on people's minds is AI. And a lot of people wondering, how is Disney using AI? How are they implementing it for sort of the next iteration?
Well, thank you for having me here. By the way, you're absolutely right. This is stunningly beautiful. I mean, who wouldn't want to be here talking to you guys? We've been using AI a lot in our advertising technology stack around our algorithms and how we're optimizing yield across our tech stack. We have been exploring, and we're really working. There's a lot of meetings actually this very week on this topic to talk about what are the process system optimizations that we can really leverage around the use of AI, really around creative and managing the volume of creative. We go through 40,000 pieces of creative today, a day, around our platform. And when we think about the scale of what we have to actually deliver over the course of time in terms of growth on streaming, we really need to automate that process. And there's been so many vendors who've come to us with great opportunities of how we can do that. We're talking to a lot of those in that area, also around advertising innovation. So think about shoppable interactivity, everything we're doing in that space as well. And so super excited about what it will be for our business, but I still think it's very early days.
Blow some minds first, Rita. You mentioned innovation. You know, for consumers and investors out there, if we're having this conversation a year or two from now, how might Disney look and feel differently because of AI?
Yes, I think it's going to be much more, you know, we talk a lot about our streaming platform today, and I think you will see a transition to an immersive platform where streaming will underpin the basic core of the reason people come there, but you'll also think about how you interact on your social platforms, how gamification comes into that, shopping comes into that experience, all within one advertising experience. Think about as well, you know, I use the example of sports because it's easiest, and as we reimagine and we further digitize our sports business, we've talked a lot about ESPN flagship in the last couple of months. But you can imagine a world where a sports fan will come to ESPN and they'll be able to do everything in one platform. Their sports betting opportunity through ESPN Bet. They'll be able to create their fantasy experience there. They'll be able to do shopping, interactivity, simulcast, watch, short form, share content. And so it's really a migration of streaming will become a much more immersive platform, or gaming, and how that will participate as part of a full experience and surrounding fans with the content and how they use it today, which today they're using it across many devices, but bringing that all together across one experience will be really important.
There's been some murmurs here on the ground at Cannes about Amazon ad prices, and they have a lot of inventory and they're bringing down ad prices on streaming. How impactful is that to Disney's business?
I think the entire marketplace right now, what you saw in 2023 was 40% growth in CTV capacity across the year. Q1, 60% growth across the CTV environment. And so scale matters, performance matters, your technology and capabilities to deliver outcomes matters. We've created interoperability across the marketplace so people can plan, buy, and measure across our full technology stack with any platform or vendor they want to use. We're in a really good place, right? Some companies are great at technology, some companies are great at storytelling, some companies are great at innovation. We're great at all three, and that's where the magic happens. And so we're very excited about our position. We're seeing that in the performance of the upfront and where people are coming first. And so we're very excited about where we're going to be able to do with clients. I do think, by the way, there's no question it's created an excess of supply in the marketplace that for a marketer, you have to figure out, where am I going to spend my dollars? What's the right partner to do that with? And I think that's where the combination of creativity and technology really meets to really deliver on the outcomes.
And you talked about sports there. We don't want to talk about this sports streaming platform that we're seeing here, obviously with Warner Brothers Discovery and Fox. A lot of people wondering what that's going to look like, the discussions that you're having pre-launch about what that's going to look like.
So Venu, which is that platform, is a partnership between us, Warner Brothers, and Fox, and it is a digital MVPD. So think of Hulu Live, another way to access sports content. We knew that there were a bunch of people who never had basically a cable subscription who are big sports fans, and so we wanted to give them a product that was priced right, that allows them to access 50 to 60% of the sports available in the marketplace in one place. And so that's what that product is. It will be part of everything I bring to clients. So as a partner, we have 60 partners, for example, in college football. All of those partners, as part of their ESPN college football experience, will have every position that they buy delivered across our full suite of products, including Venu.
Much has been made about the demise of linear TV networks, and look, structurally, it's a hurting business because of the move to streaming. But this is a presidential election year. What's the ad outlook for linear, because during political years, this is usually a pretty big time, right?
That's right. I mean, political years tend to have a spike not only on the national side, but on our stations as well. And so what we've seen is, you're absolutely right, there is a consistent decline in linear. I will say broadcast has seen a much more stable decline than our cable networks, and part of that is just the volume of that content that sits within streaming platforms. But our broadcast network has a significant amount of sports and has a significant amount of news, which is live, and a significant amount of live programming that keeps it relevant. And so there is audience decline, and so the advertising decline on those platforms is in line with that. In a political year, and as you know, we have one of the debates coming up, and so we're very excited about being able to bring that to audiences. But ultimately, in a political year, you see more advertising. It depends on what's going on from issues advertising in what markets, if there's secondary races, things like that. And so it's still a little early.
So then, being that obviously this is going to be a big boon for advertisers, a lot of eyes at a lot of different platforms. How do you see Disney competing with Amazon when it comes to the direct-to-consumer experience, and really how you're managing that ad spend?
Yeah, I mean, Disney competes with Amazon, Google, and everybody else. And so, to me, the big share is still YouTube, right? Like you just have to look at their earnings every quarter. I think we have done an extraordinary job because we have scale and we have premium storytelling and brands that everyone recognizes. And part of the streaming environment is really discoverability and finding and engagement and all of those things that feed into what the opportunity is. We have a scale and premium content. We have sports and entertainment programming. We have a combination of the three of the best platforms in the market. We actually moved Hulu onto Disney Plus, and we saw a rise not only in the consumption of time spent on the Disney Plus, but also Hulu as a standalone experience. And Hulu Live is a big portion of that, where you can actually get your full, what would be your normal cable subscription experience within a Hulu environment. We announced recently the integration of Warner Brothers Discovery as part of a bundle offering to the consumer. And so I think every platform has their, I would say, advantage, if you will, in terms of how you talk to customers. I think the fact that Hulu and Disney have been in the market a long time with an advertising business, we understand the advertising environment, we understand how clients want to talk to us, and how they want their partnerships to look like across our platform. I think sports continues to be a massive driver of opportunity, not only within our linear businesses, but in streaming. And how we bring that all together to market is really a differentiator that I don't think anyone competes with us today on.
The presence of Nvidia in the S&P 500 forecasted to grow, the AI darling potentially outshining others in the generational computing cycles. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Thanks, Josh. Well, this comes to us from Julian Emanuel's upgrade of his forecast for the S&P 500 to 6,000. It is a treasure trove of charts, but I did pick this one, which actually comes via Evercore's semiconductor analyst, Mark Lepasis. So basically, Mark looked at weightings of various dominant companies in their various generational compute cycles. What does that mean? Well, he looked at what he called the mini computer era, when DEC had a weighting of about 1% in the S&P 500. Then Nokia with the feature phone era and its weighting of about 2% in 2000 when it reached its peak weighting in the S&P 500. Microsoft during its first era of dominance in 2007, the PC era then, Microsoft was about 3% of the S&P 500. Apple, of course, the smartphone era there. In 2015, Apple accounted about 4%. And then you fast forward to today, and what Lepasis puts at the other sort of generational computing cycles. Again, the smartphone era, sort of the newer wave of the smartphone era, the data center and server era, which he says Microsoft is benefiting from, and then the AI and parallel processing era. So what does all of this mean? You notice these bars all going up during these various generational computing cycles as these companies accounted for more and more of the S&P 500. So Lepasis extrapolates for Nvidia, if we continue to see this upward trajectory, could be as much as 15% of the S&P 500 as it continues to climb in its market cap. I mean, this makes sense given some of the forecasts we've heard, Josh, for what the market cap of Nvidia could eventually get to, and we've already seen it sort of vying with the top three here.
All right, Julie Hyman, thank you. Appreciate it. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.